and bridging the divide in his transition. We'll have more highlights from that conversation later in the show. Let's get you started with a look at where the major indexes stand as we head towards the close. Abigail Doolittle is standing by on Record Watch.
Yeah, absolutely, Scarlet. What a rally we have here for U.S. stocks. And what a turnaround, too. The three major averages opened slightly lower. Now we're looking at stocks absolutely surging. The Dow and the S&P 500 both at record highs. The Nasdaq not far from a record close. And the Dow Transports putting in its first record close, or on pace for its first record close since December of 2014. Now, what could be behind some of this turnaround? The ECB tomorrow, the policy meeting. We did have a big rally in Europe and Asia. Some investors are expecting the ECB to extend its bond buying program, which would support some extra liquidity. As for one sector that's not participating, not trading higher, as you had mentioned, biotech. We have the biotech index down nearly 2% after Donald Trump did earlier indicate in an interview that he's an opponent to high drug prices. In fact, he said, quote, "I'm going to bring down drug prices." We also see, though, that biotech is off the lows. This could reflect two things. First, the fact that this could be perceived as an empty threat. This, according to Bloomberg intelligence analyst Astika Gunwardena. Second, the Trump administration did indicate that they are considering Peter Thiel associate Jim O'Neill for the head of the FDA. Back in 2014, Jim O'Neill did say that he is a proponent of, quote, progressive approval, basically a different methodology at the FDA that could bring down prices naturally. So perhaps of a less pain to the drug makers, and perhaps helping to explain why biotech is recovering a little bit today, but still down at a one-month low. And in fact, the biotech bear market continues. When we go into the Bloomberg and we take a look at BTV4667, this is a chart of biotech in blue going all the way back to its record peak in July of 2015, down 35%, a big bear market. In white, we have the Nasdaq, a big divergence between the two. The Nasdaq is up 7% this year. The biotech index is down more than 20% on the year. Now, the gamey biotech index, higher risk, could be a tell that there could be some weakness ahead for the Nasdaq. And interestingly, we do have the Nasdaq in what's typically a bearish consolidation pattern there, marked in orange, a different version of the one back here earlier this year that brought pullback. So again, the biotech index, if this weakness continues, could be some kind of a signal ahead of broader market weakness to come.
All right. Thank you so much, Abigail Doolittle.
What'd you miss? In a rare behind-the-scenes look, Bloomberg obtained access to some of the private forecasts and deliberations of Federal Reserve staff members at the center of the storm. Here with some key takeaways, Bloomberg economics reporter Matthew Boesler. Matt, fantastic scoop with your colleague Carlos Torres. Carlos Torres?
Craig Torres.
Craig Torres. So this was 2010 memo internal at the New York Fed deliberating how to, how they saw the economy unfolding and how best to combat this sort of ongoing malaise. What did you learn in this memo?
Yeah, that's right. So each of the 12 reserve banks that make up the Fed system around the country, they all have economists and analysts on staff who prepare these briefings for the presidents of the reserve banks for them to then take into the FOMC meetings and sort of be able to speak intelligently and decide what to do. And so basically what we learned in these briefings from the New York Fed was very interesting because they're sort of the Fed's eyes and ears on Wall Street, right? And 2010 was a very tumultuous time in the markets and the economy. So at the beginning of the year, it was really interesting because they were really worried about high inflation, runaway inflation from, potential, all of the excess reserves they pumped into the system. And there were concerns in the markets that, we weren't really
sure.
These were
new tools at the time. Right. No one really knew what the ramifications of QE were going to be, and there were a lot of people who thought that it was sort of money printing that would lead to hyperinflation.
Yeah, that's exactly right. And then it was a very interesting year because then throughout the course of the year, you saw the Greek debt crisis flare up, and then we kind of had the opposite concern where they became more worried about deflation, and that led to some more radical sort of policy proposals. I actually brought you guys a chart that I think illustrates this really well.
I have it right here, actually. Yep. And it's a cost protect against inflation above 4% for 5 years. That is your white line. The blue line here, and this is the one that you circled, is a cost protect against deflation for 5 years.
That's right. So you can see at the beginning there of 2010, which 2010 is, denoted by those vertical red bars, we were really concerned about high inflation, like I was just saying. That's the white line. And then you can see that throughout the course of the year, deflation became a much more concerning thing. And that was September 2010, where we have that circle.
It's interesting if you unzoom there, though, how at the time people were simultaneously concerned about very high inflation and deflation because both of them trended lower. But at the time, it seemed like we were sort of, stuck between two awful situations. We just didn't know which one was going to be.
Exactly. And so you really have this full arc of them coming full circle. And it's interesting because at the time in September 2010, when those deflation fears kind of hit their peak, basically what the New York Fed staff said was, we should tie what we do with the balance sheet to future movements in inflation. That's kind of a precursor to the Evans rule that the Fed eventually went with in late 2012, nearly 2 years later. That kind of was the open-ended QE finally.
So this is pretty radical or very different than the approach they took at the time, because everyone remembers QE2. They just threw a number out there. Was it 600 billion?
600 billion.
And they just started buying every month. And in retrospect, it wasn't the most effective program. At the time, what they said is, let's just keep buying ad infinitum until we hit a target. Or that was what their recommendation was.
Right. And so they obviously didn't end up doing that year, but then 2 years later, when you got to QE3, that's exactly what they did. And so a lot of Fed officials now, when they talk about, going forward, the next time we have a downturn, what they want to do is be less conservative at the outset and really kind of, go full stimulus at the beginning.
Mario Draghi was credited with doing whatever it takes, with his vow to do whatever it takes to save the euro. But what we've learned from these documents is that the Fed got there as well, albeit a little bit more slowly, this idea that they would do whatever it takes to meet their dual mandate.
Yeah, so Draghi, I believe, said that in July 2012. And then you had the Fed come out with open-ended QE a few months later in September 2012.
But the seeds were planted earlier than that.
That's right. So this goes all the way back 2 years before. And another thing that they were proposing, which still has not been taken up by the Fed, is something called price level targeting. And so the difference between price level targeting and what the Fed does now in targeting an inflation rate is when you're price level targeting, it says if you're missing on your inflation objective, you need to actually make up for that later. Whereas now the Fed is just saying, well, we've been underrunning our 2% target for several years, but once we get up to 2%, we're kind of good, right?
So people talk about this still. It's like, oh, is the Fed willing to overshoot? But in a way, it's kind of too late. A willingness to overshoot, it would have been very nice to have signaled that a long time ago.
That's right. But interestingly enough, we're still really concerned about low inflation, or at least we were until a few weeks ago after the election.
Then everything changed.
Yeah, but so you still hear some of the members of the FOMC, some of the Reserve Bank presidents talk like this. Like you'll hear them in their speeches this year saying, well, if our inflation target is 2%, we should really be averaging 2% over time. If we're spending time below it, we should be spending time above it as well. And that's exactly this proposal that the New York Fed was suggesting, staff were suggesting in 2010, ultimately wasn't taken up. Interestingly, one of the big opponents of it was Janet Yellen herself. She had reservations that it would be too confusing or too difficult for the public to understand and to implement. And you also had concerns about inflation at the time, like the chart showed. So I think there was, again, that sort of conservative element that ultimately kind of predominated.
And the New York Fed was behind this. It was Bill Dudley who runs the New York Fed. Talk a little bit about how influential the New York Fed is versus the other regional banks.
So the New York Fed sits sort of at the center of financial markets and the banking system here in New York. Obviously, it's a major financial center. And so they have insight into the markets that the other reserve banks may not necessarily, given they're not front and center there, kind of have. And so you could really see that as well coming through in the discussion of what was going on in markets at the time. Again, investors, you could clearly see in sort of the options prices were concerned. And, if you look at the transcripts, even Bill Dudley himself said, I'm not concerned about runaway inflation, but we need to consider that investors are. So that's important.
You talk to economists all the time. It's always hard to figure out counterfactuals. But had the Fed early on said, we're going to do open-ended QE and we're going to compensate for any periods of undershooting our inflation targets, how might have things unfolded differently?
It's a really interesting question because on the one hand, they did QE2 and then they stopped doing QE2 and then they had to eventually come back.
That was Operation Twist, right, QE2?
QE2 was right before Operation Twist, and then they did Operation Twist, and then, even a year and a half later, they had to come back and do QE3. So they ended up buying a lot of bonds. If you had just started and said, okay, we're going to do this starting now in 2010, it may be that you would have had to buy less. And the other thing is that we had a kind of an inflation scare in 2011,
right.
Where core PCE went above 2%, and people were saying it was hard to just pay for food and groceries and that sort of thing. So having it be a little more path dependent from the outset probably would have helped sort of balance and smooth out some of those things.
Well, it's a great story, fascinating thing to think about. I'm sure people are going to be talking about it for a long time. Bloomberg News, Matt Boesler, check out the story with Craig Torres on the website or on the terminal. And you've written actually a few takes on it, sort of what we've learned from it. Really interesting stuff. Thanks for coming on.
Coming up, billionaire investor Carl Icahn reacts to President-elect Donald Trump's cabinet picks and talks about whether the market has gotten ahead of itself since the election. We'll have highlights from that conversation. This is Bloomberg. All right, let's get your check of markets as we head towards the close. Take a look at this chart here on my Bloomberg. The white line is the Dow Jones Industrial Average, and the pink line here is the S&P 500. What's important here is to note just how steady this rally has been all throughout today's session. We have crept our way higher, seemingly without an obvious catalyst.
Today's market feels very like we were saying earlier, June of this year, where just everything was green. Bonds, real estate, stocks, tech, everything. It's just cash being thrown at everything today.
Cash being thrown at everything, and the Dow, of course, at a record high. The S&P 500 now at a record high as well. We'll continue to monitor these advances, but right now stocks continue to move ahead.
President-elect Donald Trump is said to have chosen Scott Pruitt, the Oklahoma Attorney General and a close ally of the fossil fuel industry, to run the Environmental Protection Agency.
Carl Icahn, chairman of Icahn Enterprises, joined Bloomberg Television on the phone earlier today in an exclusive interview to talk about how he may have influenced Trump's decision.
Yes, Donald asked me my opinion on it, and I've been very involved as far as the EPA and other regulatory agencies. Some of them are okay, some are not so okay. The EPA, in my opinion, has gone way too far and sort of run amok with these crazy regulations. One regulation that is completely, totally absurd, and I've seen many absurd things in my career, is this obligated party where they obligate refineries to blend, and you can't blend because nobody will buy our blended gasoline. So you've had a tremendous transfer of wealth from the obligated party, which is the refinery, to big oil and to these gas station chains. And I think this hopefully will come to an end. They've been talking about ending it already. I've spoken to Scott Pruitt, I'd say 4 or 5 times, got to know him. I really think he's a great pick. I told Donald that I think he's somebody that I think will do away with many of the problems at the EPA, and they have many of them. And, you know, I do believe, I can't speak for Scott, but I've spoken to him, and I think, I do think he feels pretty strongly about the absurdity of these obligations. And
Carl, what do you want to see out of the gates here as far as EPA's involvement with the fossil fuel industry? Has this shift to clean energy and that emphasis over the past 4 to 8 years here sort of have a momentum enough, or is there changes that can be made from the EPA to sort of reinvigorate that industry?
Reinvigorate which industry?
Fossil fuels. Do you think this is going to be an administration that goes back and gives some more leniency?
Yeah, I do think there'll be more leniency in that fossil fuel area, but I want to make it clear that what I'm talking about are some of the regulations that are literally insane that the EPA has done. And it has really, if you understand it, it gets a little arcane. What I'm talking about has nothing to do with the RFS. I mean, look, I have opinions about the RFS, you know, the renewable fuel standard, and that's something that a lot of people argue about. And you can make, I mean, I can understand that there are arguments to be made. Don't change the RFS at this point. So we're not even talking about that. We're talking about getting rid of this goddamn ridden wall and this obligation that are putting refineries out of business. I mean, the government was never meant to really ruin companies for no reason, because there are some people up in Ann Arbor at the EPA that decide in their great wisdom, who've never had business experience, that now they're going to put some of these refineries out of business and for no reason enrich these gas station chains. The whole thing has been, you know, look, I get enraged by some of these things at corporate America, and at the risk of being modest, made billions of dollars, not only for myself, but for all shareholders. And I think here, I think it's so outrageous that I hope I could be a part of a team that does away with these crazy regulations that you have through the EPA and whatever. But, you know, I'm not even talking about the big picture question, the RFS. I mean, so the EPA is throwing out the baby with the bathwater. I mean, if they really want the RFS, this is the stupidest way in the world to have tried to keep it.
Right.
And I'm so glad there's going to be a change there.
And you've made that point before.
I guess I can't be clearer than that.
No, that's pretty clear, Carl. I want to pivot a little bit here and ask you about your thoughts on what Donald Trump has said and done when it comes to other companies. Are you comfortable with him calling out companies like Carrier, like Boeing, whether it's Carrier moving jobs or Boeing's Air Force One project and the price tag involved in that?
Well, I think Donald wants to create jobs in America, and he's going to do whatever he can to do that. And again, I say one of the best ways is to let the country, let business know that the government is not at war with them. What he is trying to do is say, hey, to a company, don't leave our country so fast because we're not at war with you. And I think what he told Carrier right on is saying, hey, look, regulations are going to change here. It's going to be a new world here for you. So don't leave so quickly. And this is why these regulatory agencies, some are okay, and I'm not saying every regulation shouldn't be made, and there are good regulations, and you need them, but they've gone, in many cases, almost insane, and what Donald is trying to say is, don't leave our country. We're going to get rid of a lot of these regulations. I mean, like I keep going back again, I guess, to this crazy obligated rule. They should change that immediately, if possible. So how do you obligate somebody to do something that they can't do? So, yeah, I'm saying that as far as I'm concerned, Donald is coming in and saying we must get jobs back in this country, good jobs.
I hear you on that.
That the regime is over. So, okay, so I think with Carrier and all that, I think he's really saying to him, hey, look, don't leave this country. stay here. We're going to help you with regulations. We're going to help you every way we can. I don't want you to leave, okay?
That might be the case, Carl, but is he picking winners and losers?
I think, who did he pick? He's just telling Harriet, don't leave the country. I mean, he's not picking anybody.
That was Carl Icahn, Icahn Enterprises chairman, in an exclusive interview with Bloomberg Television.
Up next, the UN declining to an 8-year low and China takes action. We show you how next. This is Bloomberg.
I'm Scarlet Fu. What you missed, equity markets around the world keep their cool. You can almost call it complacent after the latest political upset, the Italian referendum. So this is the 10-day volatility of the MSCI All-Country World Index, which includes both developed markets and emerging markets. The red dotted line here was the Brexit vote, and you could see that 10-day vol shot up after that. And then, Matt, if we go along to early November, the blue dotted line marks the U.S. election. And yes, we did get a move up before the election. And then you move to the yellow dotted line, and that was the Italian referendum. In all three political events, the establishment lost, but this time the polls got it right and investors were positioned correctly. And across the globe, we're looking at banks leading gains as bond yields rise, bonds sell off. And today, for instance, around the world, I was just looking at WEI Go, Joe, everything is in the green.
It really is remarkable how 2016 was supposed to be the year of political risk and political volatility, and none of that panned out. And now, like, I'm reading the strategist reports for 2017, and now they're talking about this is going to be the year of policy risk, people not knowing what policies will come as a result of all these surprise elections. But political risk didn't work out. We'll see what happens.
Political surprise, yes, not necessarily.
Just nothing bad happened in the markets as a result of any of these votes. All right, I'm looking at China in particular, its gigantic, legendarily huge cash pile, which in the middle of 2014 peaked at $4 trillion U.S. dollars. Since then, it's been steadily grinding lower. It's now down nearly $1 trillion from that peak in the summer of 2014 as a combination of weakening currencies and people taking their money out. And, of course, a lot of it, the country has to burn through its currency in order to keep it up. You can see if you look at the very deep corner there, this was the worst month of FX outflows since very early time of the year. I think it's worse in about 10 months. So this is an ongoing issue. China hasn't caused global market volatility in a while, but the money continues to bleed out.
Well, and part of it is because it's devaluing its currency very gradually, very consistently, as opposed to in a one-off.
Right. There hasn't been volatility associated with it, but the underlying trends of money coming out and having to spend money to prop up the UN maintains an issue.
All right. The market close is next. Take a look at those big gains. The Dow up 273 points on its way to a record close. The S&P also higher at a record close. This is Bloomberg. Moments away from the closing bell. What'd you miss? An early afternoon advance lifting major U.S. benchmarks to all-time highs. Sovereign debt also getting a boost as speculation mounts that the European Central Bank will prolong its bond buying program. I'm Scarlet Fu.
And I'm Joe Weisenthal. I want to welcome the viewers who are tuning in live on Twitter. You can watch our closing bell coverage on Twitter every weekday from 4 to 5 p.m. Eastern.
We begin with our market minutes. Record closes for the Dow, for the S&P, for the Dow Transports. The Dow rose 306 points at its session high. And in fact, this is the 12th record close since the election.
I remember when Dow 10,000, people had Dow 10,000 hits, but look at, we're pretty close to a Dow 20,000, which will be pretty remarkable. It's just a remarkable day in the markets everywhere you look.
Everywhere you look, and it was a steady grind higher through the afternoon as well. If you come inside the Bloomberg and take a look at the sectors that are participating, it's pretty notable. 10 out of the 11 sectors were gaining or are higher by the end of trading today. The exception here was healthcare, down 0.9%, but even in that case, 41% of the names in healthcare were down.
Trump.
And that was because of Trump. I'm glad you bring that up. There was also something else. There was some fundamental news. Abbott Laboratories, for instance, filed a suit to terminate its $5.8 billion purchase of Alere. So you saw that name actually, that name moved higher, but Alere took a dive, down 8%. But yes, you mentioned Trump, Donald Trump vowing to bring down high drug prices in his interview with Time magazine. I feel like we always need to say where we got that information
from.
Where
it came out.
Because it might be in a tweet, it might be in a conversation. You never really know. The Nasdaq Biotech Index down 2.9%. This is just one of the big names I plucked from the NBI. Bluebird Bio down 11% on the day.
Trump making news in a Time Person of the Year interview, huh?
Yep. Exactly. What about bonds?
I want to look at the 2-year and the 10-year where yields were noticeably lower, and this is sort of what makes today's market so remarkable, which is that we saw big flows into stocks and into bonds at the same time. Remember, price goes up when yield goes down, so yields are going down. That means people are buying U.S. Treasuries, and that's what I said earlier in the show. It really felt like this summer when we'd have these days where literally everything went up all at once. We haven't had as many of those days in a while, but today definitely was one.
Maybe it's because there's another central bank meeting tomorrow.
Could be
that's
the
why.
central bankers back in action.
Yeah, there's a lot of wait and see before the ECB meeting tomorrow, where Mario Draghi is expected to announce he'll extend QE beyond the original deadline of next March. So if you look at some of the major pairs, the pound weaker after industrial production numbers disappointed. I'll get to that in a little bit later. You can see the euro gaining ground versus the pound, versus the dollar, versus the yen. So euro clearly moving farther away from parity. Remember, it started this week at a 20-month low in intraday trading, but it had a quick snapback, and it's now at its firmest against the dollar, at least, since mid-November.
And let's take a look at commodities, some random ones across the board. Silver having a really good day. That's just one that's gotten totally clobbered since the election.
It's a risk-on commodity.
Because, yeah, it's a commodity, and it's precious metal, so it's been getting destroyed since the election, but it finally had a pop day. Whole milk in New Zealand had a good day. One of my favorite currencies to watch. Sort of the New Zealand dollar always takes a cue from whole milk. And West Texas Intermediate crude continuing to fade down 2%. So some of that OPEC euphoria coming off the market a little bit, now down below $50 a barrel.
All right, we're always watching that $50 level. Those are today's market minutes. And let's take a deep dive now into the Bloomberg. You can find our charts using the function at the bottom of the screen. It would appear that maybe Brexit is finally starting to show up in UK numbers. Earlier this month, you had PMI coming in below expectations. That is the drop there in the yellow line right there. Today, you had manufacturing production unexpectedly declining in October, and there's that leg lower. The purple bars here, meantime, are economic data, economic surprise index. So data is no longer beating expectations to quite the same degree. There's that drop off there. So it turns out that oil and gas mining was a big part of the drop in the manufacturing production, maintenance in the North Sea. So we'll really need to see whether manufacturing output specifically continues to be a drag, but that's going to be something that people watch for in the months ahead.
And there has been some scattered weak data today is notable. So in addition to that, there was some German industrial data that came in weak. Australia having its worst quarter since like 2008. So maybe some of the good news in the economy, maybe that partly contributed to why yields dropped today.
It doesn't explain why equities were flying, though.
Unless it means fewer hikes.
Unless it means fewer hikes.
You never know. All right, let's take a look at it. We talked about silver earlier. Precious metals really have been doing terribly. Here's a chart of flows out of precious metal ETFs. That chart really what tells you all you need to know. Look at that huge down bar of people pulling money out of precious metal ETFs.
There's like no transition. It just went,
it just went from everyone loved it to everyone hating it, going back to 2013. Really shows you how quickly there's been a turnaround on this stuff. And now let's talk about some other safe haven trades and some sort of fascinating things we're looking in this sort of post-election period. I want to bring in Bloomberg's Luke Kawa. Luke, thanks for joining us. You flagged something really remarkable that happened earlier this week, which was that there was this huge surge of money into ETFs that were sort of short duration ETFs. Basically, everyone coming out of long bonds and long treasuries into things that were very unsensitive to rates. Tell us what you saw.
Exactly. So on Monday, the top 5 inflows into bond ETFs were all things like the main thing they had in common was that they either like held floating rate bonds, variable rate, or very short rate corporate debt, junk debt, or just, sovereign debt, plain old vanilla. So, and the biggest outflows the same day was Vanguard's long-term bond fund, which, most of those things mature after 2040. So what this really tells us is that, in September, I was talking to Kathy Jones at Charles Schwab. She said, duration risk, that's the one thing my clients don't ask me about anymore. Everybody thinks lower for longer is lower forever. And now that's the one thing everybody's worried about.
This is the chart Scarlet brought up on her terminal, hashtag BTV2977 for those who have a Bloomberg. So that huge spike, what are some of these near float, SJNK, what are some of these ETFs?
So that's the iShares short maturity bond ETF, floating rate bond ETF, Barclays short-term debt. So some of them, are safe havens, but others, you're still taking on default risk. This is still corporate debt we're talking in other places.
But the common thread is that they're protection against a rise in rates.
Yes, protection or at least less vulnerable.
So forgive the obvious question here, but when we talk about duration, it's more than just seeking out 10-year or 30-year securities, isn't it?
Yes, exactly. So almost what I was just mentioning. So the kind of bonds that you'd think would be most sensitive or have the most duration risk are things like long-term sovereign debt in safe nations, U.S., Swiss, Germany, because so much of it, there's very little default risk associated with those. Yet over the life of the bond, there's a lot of sensitivity to fluctuations in interest rates affecting the price.
It's just funny that you would have duration being measured as interest rate risk when you're investing in fixed income. Like, how can you strip that out?
Exactly. It's, well, just there's different components of it as opposed to like default risk in corporate bonds. That would be the easiest differentiator. And
so today, in the action that we've been talking about today, one of the things that makes it really remarkable is that rates have really come in. We've sort of got one of these everything rallies, the likes of which we haven't in a while. And you could look at a chart like that and you might say that that might have been a tell that on Monday, this is Monday, I think that we saw that huge flow, that on Monday there was this huge flow into assets that were avoided risk of duration, and then we get the huge duration rally today.
I think Scarlet was almost onto it perfectly earlier when she was talking about Mario Draghi and the ECB having the potential to kind of crush and bring in risk premia. We know we had the Fed crushing risk premia, then they handed it over to the ECB, BOJ. U.S. fiscal policy expectations kind of reversed that, but now we have the potential tomorrow for central banks to kind of grab the narrative again.
Now, there have been duration rotations in the past, right, over the last 5 years. We've seen this before, but they never really panned out. What's different this time?
I think the thing that's most different this time is I was earlier today just at Bank of America's year-ahead outlook, and the baton seems to have been passed more fully to fiscal policy, a lever that has a lot more room to work, and kind of I'd say the expectation that inflation is rising, data is firming, seems to be much more entrenched. You have signposts like Chinese factory gate inflation coming back. So I think a lot of that tail risk has kind of been siphoned out of the market.
Now, we've heard so much about the potential for fiscal policy since November 8th, and everyone's like, the long-awaited fiscal stimulus is coming. Are people thinking that that story has gotten a little bit too ahead of itself, that we really don't know what's coming, it might not be as big as people think, and that it's more just sort of a market meme than something that'll actually affect the economy?
I'd say that's a very fair statement. Talking to David Wu earlier, he said he does expect that the potential for more upside risk than what's built into BAML's baseline forecasts. But even he says fiscal policy, the infrastructure spending, that's at best a late 2017 story. So it's it's not something we can get too excited about and expect to see soon. And that's something that if you look at Canada, Trudeau's infrastructure spending hasn't really showed up yet at all.
Another obvious question: where does this duration rotation leave munis, for instance?
That's unless that's tough to tell. I wouldn't be able to offer any kind of intelligent comment on that.
Are they low duration or high duration products, or it depends?
Well, they have more kind of credit risk built into them than say your U.S. Treasury.
True.
It's along the scale.
All right. You can always find something that matches your risk profile.
All right. Follow Luke's stuff for a great tracking of these ETF flows, because sometimes they pick up really interesting turns like that. Bloomberg's Luke Kawa, thank you very much for joining us.
All right, let's just get a recap here of what happened in equities today. The Dow and the S&P closing at their all-time highs. We also had the Dow Transport closing at its best as well. You had 10 out of 11 sectors in the S&P 500 finishing in the green. The lone exception there was healthcare companies, and it came after Donald Trump indicated that he does not favor high drug prices. He wants to bring those drug prices down.
Coming up on Bloomberg, we look ahead to 2017's economic road with Michelle Meyer, head of economics at Bank of America Merrill Lynch, who will give us her outlook. This is Bloomberg.
I'm Nina Melendez. Let's get to First Word News this afternoon. President-elect Donald Trump has nominated Iowa Governor Terry Branstad as U.S. ambassador to China. He's a longtime friend of President Xi Jinping. Chinese Foreign Minister spokesman Lu Kang called Branstad an old friend of the nations. Branstad and Xi met when China's leader made his first trip to Iowa in 1985 during a sister state exchange. President-elect Donald Trump says that Mitt Romney is still in the running to be Secretary of State. Trump said he and the 2012 Republican presidential nominee have come a long way together, despite Romney's harsh criticism of Trump. The president-elect told NBC he'll be announcing his choice soon.
I think next week will be the time that I announce it, and I have some other big announcements coming up today and actually tomorrow. But we've been met with, really very good reviews of the people that I've chosen.
Meanwhile, Trump has been named Time Magazine's Person of the Year. Time says it gives the title to the person who has had the greatest influence on events, for better or worse. National investigators say the driver of a Baltimore school bus that smashed into a transit bus last month was speeding and had a history of crashes and seizures. The accident killed 6 people. The National Transportation Safety Board said the driver was going nearly twice the speed limit when he struck a Ford Mustang from behind, then struck the transit bus. Global news 24 hours a day, powered by more than 2,600 journalists and analysts in more than 120 countries. I'm Nina Melendez. This is Bloomberg.
Thanks so much, Nina. We also have some breaking news here. According to Reuters, Donald Trump has chosen Linda McMahon for his Small Business Administration head. So Linda McMahon, who, of course, married to Vince McMahon, was known for developing World Wrestling Entertainment. She is a wrestling magnate. She's also a former Republican Party candidate. She has been, according to Reuters, chosen as Donald Trump's Small Business Administration head. We'll continue to monitor these headlines for you. What'd you miss? 2016 has given us Brexit, President-elect Donald Trump, and a cautious Fed that'll end up raising rates only once this year. We have seen unusual events, including the expansion of negative interest rates and an OPEC agreement to cut oil production. 2017 is expected to be just as volatile, with Trump taking office, an unsettled Europe, and lingering concerns on China. Here with us now to discuss how she sees next year taking shape is Michelle Meyer. She's head of U.S. economics at Bank of America Merrill Lynch. And Michelle, when you were formulating your 2017 outlook, the headline that caught my eye was that you see only one Fed rate increase in 2017. It won't even come until the second half. What's going on there?
Yeah, so that is a bit unusual. It's out of the consensus, I would say. And I think the reason for it is that Janet Yellen will still be the head of the FOMC. I think she's still going to be embracing a pretty cautious attitude towards the hiking cycle, still thinking about a normalization process. And I think in terms of what will change in the medium term, the big story is fiscal stimulus. But the fiscal stimulus is unlikely to kick in until some point in the end of 2017. And really, it's a big story for 2018. So when you think about the first half of next year, you're supposed to think about, kind of that same economy that we had previously, that we've had this year. You're supposed to still think about, the relationship with interest rates and the dollar. The dollar has strengthened. Interest rates have increased, which is some tightness in that respect. So my view is that the first half of the year is a little bit softer in terms of growth. Yellen will remain cautious. Into the second half of the year, we start to see fiscal stimulus kick in, growth accelerates, and that allows for Yellen to ramp up the hiking cycle.
It is pretty remarkable the degree to which markets are repricing things like inflation, long-term interest rates, and so forth. We talk a lot about since the election, but it really started in the middle of July, the rise in rates. Has the market gotten ahead of itself? Is it now sort of in line with where fundamentals should be, or would dictate that things should be? Like, what do you think is like the story of what's really going on here?
Yeah, so that's a really good point that I think people kind of forget, is that a lot of this was moving in advance of the election, particularly around inflation and inflation expectations. They were starting to shift higher. The market was starting to get a sniff of the idea that we're moving from a disinflationary environment to one where we can start to see some inflation. So in my view, the move, particularly in inflation, has kind of been a reset to levels that are more appropriate. I think the question going forward, and you can see from this chart, is, our forecast for core PCE inflation and headline inflation, we're going to get to 2%. maybe by the end of next year, but certainly it seems like by 2018, and that's the Fed's target. So that's when I think this story really starts to change. You're at target. How much above target are we going to be able to see? How much above target does the Fed kind of allow in terms of that overshoot?
But there are different types of inflation. People call it good inflation, bad inflation. You've got asset price inflation, like in stocks, like in bonds. You've got wage inflation, and you've got price inflation. Yep. Is there an order in which it's supposed to appear?
Yeah, so, well, we've seen asset price inflation, and I think generally when you think about monetary stimulus, it will most directly feed into asset price inflation. And that was certainly the case in the environment of QE and effective lower bound interest rate policy. So we've seen that. We're still seeing that clearly. And then I think the question is, when do you start to see wage inflation and price inflation, which kind of have this nice feedback? And I think that we're on the cusp of that. We are now seeing this trend higher in underlying inflation. Wages are heading higher. The labor market is either at or very close to full employment with a 4.6% unemployment rate. So I think you're going to continue to see that story play out, where you have this relationship, this positive feedback between wages heading higher and underlying price inflation moving up too.
You mentioned earlier the strength in the dollar and the rising rates, both of those having the effect of tightening financial conditions a little bit. The dollar in particular could actually act as a dampening on inflation, particularly import inflation. How big of a factor are those financial, is that financial tightening going to be on the real economy?
Well, I think that, we can look at what happened in 2013 with the taper tantrum around rates. We can look at what happened in 2014 with, kind of a dollar tantrum. So both of those are good examples. And I think for interest rates, it's a little bit harder to quantify the impact. But for the dollar, we saw directly a widening out in the trade deficit, and we saw core consumer import prices fall, which by our models had led to a slowing in inflation. So I think depending on how much the dollar moves from here, you could have maybe a 5 to 10% appreciation pre-election through early next year, and that's significant. So I think one of the components in our forecast is that we do have a widening out of the trade deficit next year.
Productivity gains have been fairly elusive in this economic recovery. What's your confidence that Donald Trump's new infrastructure investment and spending could boost productivity?
So I think, and this is something that I found that Chair Yellen talked a little bit about in her testimony to Congress 2 weeks ago, is this idea that not all fiscal stimulus is the same. There's certain fiscal stimulus programs that enhance productivity and could boost potential growth, and there's others that kind of borrow from the future and create some sort of excess and boom. So I think you hit on something important, which is infrastructure spending. To me, an infrastructure spending program, if that were to happen, that could actually work to support productivity growth and support trend growth and maybe extend the business cycle. But I think it's unclear at this point as to when that would be implemented, how big it would be. There's lots of questions still. In terms
whether it'll be tax credits or whether it'll be actual government spending.
Yeah, and it has a different impact to the economy.
All right, Michelle Meyer, head of U.S. economics at Bank of America Merrill Lynch. We're going to focus on housing next and whether we can expect to see more real estate growth here in the U.S. This is Bloomberg.
And we're back with Michelle Meyer, head of U.S. Economics at Bank of America Merrill Lynch. We want to talk about housing. Housing is one of the big stories this year, one of the key reasons why people are bullish on the economy. If we go into the Bloomberg, we can start to see, evidence at the margins of how rates affect the market. As a look at 30-year yields inverted with the MBA mortgage refi index. Obviously, when rates go up, I've flipped them, refis go down. All these things, they trickle into it. And so what is the impact of these higher rates we've seen, a pretty significant backup in long-term rates, going to be on people's sort of willingness to take out a mortgage?
So I think, you point to the relationship between interest rates and refinancing, which is clear.
Very tight, right?
It's a very tight relationship. I think that there's a little more uncertainty as to the relationship between interest rates and purchase applications, or the ability to buy a new property, because it's not only the level of rates, it's also the level of income. It's about the expectations for future income, the expectations for home prices. So I think, if you can, generally higher rates mean is a crunch to affordability, but if you can make the case that higher interest rates is indicative of more confidence and greater income growth, then they're offsetting factors.
Well, housing starts were pretty strong in October. I think this is something you noted in your latest research. They reached a high for this cycle. Gains were really across the board, single-family, multifamily homes, every major census region. Is this sustainable even with this backup in yields and the climb in mortgage rates?
I think there's reasons to be concerned. Last month's report, which was exceptionally strong, looked like a lot of noise. So, following the housing data for many years, you see these weird blips on a monthly basis that end up getting revised or reversed to a certain extent. So I would imagine that happens in the next report. But I think the bigger picture is that, should we be worried about some weakening early next year if you have a further increase in rates before you have that accompanying gain in income? So I do think, particularly for single family, there could be some concerns.
Going into one of the things that the housing bulls point to is they say, this isn't even a cyclical story. This is a story of we were so underhoused, housing completely collapsed, and now we have this millennial generation, all these new homeowners for household formation. There's just going to be a lot of demand that's going to be there, and a lot of building that needs to happen regardless of the cycle. Do you believe that fundamental driver is a true phenomenon and that will continue for a while?
You do have population dynamics that are supportive in that the millennial cohort is a large population group, and they're going to be creating households, and the household formation spurs demand for new housing stock. So that story is right, but it's very hard to disentangle those structural stories from the cyclical components. In order for that population to form a household and to buy a new property or even rent, you need job creation, you need confidence, you need credit extension.
Cash for a down payment.
Yeah, so you need those cyclical stories to play out.
All right, Michelle Meyer, great to have you on, head of U.S. Economics at Bank of America Merrill Lynch. Thanks for joining us with your outlook for next year.
My pleasure.
Coming up next, they first met back in 1985. Now it appears that Chinese President Xi Jinping and Iowa Governor Terry Branstad will be spending a lot more time together. We look at the skills that Branstad will be bringing to Beijing. This is Bloomberg.
Nina Melendez. Let's get to First Word News this afternoon. President-elect Donald Trump is nominating former two-time U.S. Senate candidate Linda McMahon to lead the Small Business Administration. McMahon is a former CEO of World Wrestling Entertainment. She met with Trump last week and was an early supporter of his presidential campaign. And Trump has tapped General John Kelly to head the Department of Homeland Security. That's according to reports by multiple media outlets. The selection will reportedly be announced in the coming days. Kelly is the third general picked by the president-elect to serve in his administration. A new study says repealing President Obama's health care law without a clear replacement risks making nearly 30 million people uninsured. The analysis from the nonpartisan Urban Institute finds that 22.5 million people would lose coverage directly due to the repeal of the law's subsidies, Medicaid expansion, and its individual requirement to carry health insurance. Italian Premier Matteo Renzi has resigned after a sweeping defeat on his reforms agenda that was central to his nearly three-year-long government. President Sergio Mattarella has asked him to stay on in a caretaker role until a new government can be put in place. Mattarella will start consultations late tomorrow with various party leaders to see where support lies for a new government. Global news 24 hours a day, powered by more than 2,600 journalists and analysts in more than 120 countries. I'm Nina Melendez. This is Bloomberg. Scarlet?
All right, thank you so much, Nina. Let's get a recap of today's market action. The Dow closing at yet another record high. It's 12th since the election. And the S&P also joining in on the fun because it closed at an all-time high as well. Indeed, so did the Dow Transport Average as well. The NASDAQ, you're seeing there up 1.1%. And, Joe, we're talking about how maybe there's a bit of a rotation going into tech stocks now.
Everything was up today, including a lot of the post-election losers like the bond equivalents and bonds and the tech stocks. Just green everywhere you look today. What do you miss? More cabinet picks rolling out today. Earlier, we reported that President-elect Donald Trump has tapped Linda McMahon, co-founder of World Wrestling Entertainment, for head of the Small Business Administration. He's also going to appoint Iowa Governor Terry Branstad, a longtime friend of Chinese President Xi Jinping, for ambassador to China. Branstad and Xi met when China's leader made his first trip to Iowa in 1985 during a sister state exchange. You see the photo of them there looking young and
chummy.
Chummy 30 years ago, and now here they are going to be reunited again. Branstad's new role is critical as China is the U.S.'s most important trading partner and its largest economic rival. Joining us for more from Washington is Bloomberg News White House editor Alex Wayne. Alex, thanks for joining us. Let's start with this announcement of who's going to be the ambassador to China. Obviously, Donald Trump has antagonized China in various ways on the trail and even since becoming president-elect. But now he's set to appoint someone who's kind of been a friend of the country for over 30 years. So what is the move here?
I think it's a bit of an olive branch after Trump took that call from the Taiwanese president that was probably set up well in advance. And that, of course, really offended the Chinese. They were fairly reserved in their reaction. I think they are starting to figure out that Trump is first and foremost a negotiator, and he's going to start out with the stakes as high as possible.
Well said. Now, Alex, do we know if Branstad agrees with Donald Trump when it comes to branding China a currency manipulator and arguing that China is not doing enough to buy American exports? Or does that not even matter? Because as ambassador, he's basically going to be saying what Donald Trump wants him to say.
Yeah, it doesn't matter what Terry Branstad's opinions are, to be frank. He's going to enact Donald Trump's policies. So if Donald Trump wants to declare China a currency manipulator, Terry Branstad is probably the guy who gets to deliver the message to them.
To his friend.
But as you say, from a sort of personnel, sort of what it symbolizes, it does seem sort of like a kind of savvy move and maybe sort of to placate things a little bit. Yeah,
I mean, Xi and Branstad are buddies, so at least you know that your ambassador is probably going to be greeted with an open door when he goes to deliver tough news to the Chinese government.
In terms of the other cabinet picks, we got the Homeland Security pick as well, General Kelly. So it now looks like Donald Trump has two military leaders as part of his cabinet. He hasn't picked a Secretary of State yet, right? No.
Still not yet.
Still not yet.
Right.
Is there a point at which you generally don't want to appoint any more military leaders because you need someone who actually has the experience of governing?
Well, there's a long tradition in this country, of course, of civilian command, including over the military. You don't want people who aren't elected making decisions on when to start wars. That's a 200-year history. So that's the concern. Remember, though, that Barack Obama appointed a few generals to his administration when he was first elected. He appointed a general to lead Veterans Affairs. He appointed generals as his national security advisor and as his director of national intelligence. Now, Trump has appointed 2 generals to cabinet positions, might see a third at Secretary of State, although I do not give Petraeus long odds of making it through the Senate. So
we have to get your daily assessment of where you think things are in the Secretary of State stakes. Where any new information today?
No, the last guy he met with that we know of who is seriously under consideration is Rex Tillerson, the Exxon CEO. He's pretty tight with Russia. I'm not sure that Donald Trump wants to send that signal, given the speculation already about his ties to Russia. So I'm not crazy about Tillerson. Of course, I'm down on Romney, as you guys know. I don't think Petraeus has much of a shot. If I were to put my money anywhere, it'd probably be Senator Bob Corker, actually, of Tennessee,
really?
the Republican.
Oh.
Yeah, he's not been mentioned a lot lately. He may have faded from the top ranks of Trump's list, but I think as Trump goes through these other folks and figures out their weak spots, he might well circle back to Corker.
Yeah, and his name was on the list from the get-go.
Right.
I also want to get your thoughts on Scott Pruitt. We actually talked to Carl Icahn, the billionaire investor, a little bit earlier today about Donald Trump's tapping the Oklahoma Attorney General to head the EPA. Take a listen to what he said.
I've spoken to Scott Pruitt, I'd say 4 or 5 times, got to know him. I really think he's a great pick. I told Donald that I think he's somebody that I think will do away with many of the problems at the EPA, and they have many of them.
All right, so Carl Icahn has given it his big thumbs up, and for the main reason that he would roll back a lot of the regulation that Icahn says is choking the fossil fuel industry. What can you tell us about what Scott Pruitt would likely do? I mean, how many of these regulations can he tackle on his first day on the job?
Yeah, well, he's a climate change denier. So presumably he would try to quickly get rid of the Clean Power Plan, and of course he would be on Trump's side as he tries to withdraw from the Paris climate deal. I think Scott Pruitt. I think Democrats in the Senate are going to go to the mat over Scott Pruitt. You're going to see a huge fight over this guy. I think Democrats really have to wage a war over him because climate change is one of those issues where they really try to distinguish themselves from Republicans. So I think they will really try to peel off a few more moderate Republicans and defeat his nomination.
All right, Alex Wayne of Bloomberg News, White House editor, thank you very much.
And we've got some breaking news on Italy. Moody's, the ratings company, has changed its outlook on Italy from stable to negative. And this comes on the day that Matteo Renzi, the prime minister, resigned. Italy's long-term senior unsecured government bond rating is affirmed at Baa2, according to Moody's. And just another headline here. Moody's says it expects Italy's debt burden will increase next year. Right now, it sees Italy's debt to be slightly over 133% in 2017, and it will only decline very slowly after 2017. So obviously a lot to do with the banking industry and the repairs that need to be done there.
And of course, we talk about the ECB backstop, but it's premised on the idea that Italy could keep its fiscal fiscal affairs in order. So obviously some concerns growing on that, and then you have to wonder about the backstop.
Okay, no real change in the euro following those headlines. This is Bloomberg. deeper look into China's relationship with the U.S. and the uncertainty surrounding the incoming administration's foreign policy for Asia. Let's bring in Brandywine Global Co-Director of Global Macro Research, Chen Zhao. Chen has served as a senior advisor to several government organizations in China. He was formerly a professor at Beijing's Central University of Finance and Economics. Chen, great to see you again. Thanks for joining us. There was a huge uproar when the president-elect spoke with Taiwan's president by phone from all kinds of corners. Donald Trump, of course, could make the argument that in treating Taiwan as an equal, the U.S. is backing Chinese leaders that are democratically elected. Why would this argument hurt America's national interests?
Well, this is a very sensitive issue. I don't understand why President-elect Trump actually has taken that call. The reason I'm saying that is that actually since '79, one China policy has been the bedrock for China-U.S. relationship. So if you really trying to cross that line by taking a call directly from Taiwan's president, you send a message that this one China policy may not be honored. In that case, all bets are off. So the Chinese government will be very nervous watching this. And of course, so far, their response has been very measured. They are trying to make a point where I understand the difference between the message from a government in waiting, from the policy from the government in charge. So they are still trying to figure out exactly what this means. But make no mistake, this is the most sensitive issue of Sino-U.S. relationship.
And of course, Joe, Jamie Metzel of Atlantic Council was saying that he believes that when it comes to China, Taiwan matters more than the Chinese relationship with the U.S.
Right, so what kind of ramifications could we see? You know, you said all bets are off, but what does that mean practically? And let's say Trump were to continue this sort of, carry this over into the actual administration. What happens if all bets are off?
There could be a potentially very devastating and dangerous consequences from that. For example, if the United States government saying, well, I'm no longer honoring the one China policy, that may very well encourage Taiwan to move towards separation. If that is the case, the mainland Chinese government may not have any other option but to launch an attack because they are facing 1.3 billion people at home, and 1.3 billion people have this deeply held view that Taiwan is a part of China. So if you let Taiwan to drift away, and no government can handle that pressure. So you may very well push the cross-strait relationship into an extremely volatile and a possibly very dangerous path.
And of course, Donald Trump has also accused China of manipulating its currency. But you point out that the yuan is actually the world's second strongest after the U.S. dollar. Does that even matter if Donald Trump is concerned about fulfilling his campaign promise?
I think this is a very ironic thing, too. For example, if you look at the Chinese currency, yeah, the Chinese government has been manipulating the currency, but they are manipulating the currency in favor of the United States because they are fighting a war of capital flight. They are trying to hold up the Chinese currency instead of pressing it down. So if you look at the Chinese currency over the last 2 to 3 years, the Chinese currency have appreciated a lot along with the U.S. dollar. The only currency that the Chinese yuan has depreciated somewhat is against the dollar. Virtually against all other currencies, the Chinese currency has been strengthened. So that is one thing you have to keep in mind. Another thing is that if you look at the Chinese currency, the typical signs of an undervalued currency is not there. The Chinese current account surplus is almost evaporating. If you look at the Chinese export, the export performance has been pretty lousy. So if you take all that into consideration, you cannot really make a strong case to say that the Chinese currency has been manipulated on the downside. So I don't see you can make that case at all.
Yeah, we see there's the chart here that we have up on the air. The Chinese trade surplus having shrunk quite a bit, certainly much smaller than it was pre-crisis. Earlier in the show, we showed the Chinese FX reserves now down nearly $1 trillion from when they peaked in the summer of 2014. What's your assessment of what's going on in terms of the capital flight? It hasn't roiled the markets this year the way it did at the end of the year or maybe at the beginning of the year. What's going on with that in your view?
There are a couple of things you have to take into consideration. Of course, the first thing is that since the Trump election, all emerging market currencies have taken a beating, including the Chinese yuan. So that's the first thing you have to take into consideration. So if you look at the Chinese yuan against all other EM currencies, the Chinese yuan is not particularly weak. So that's the first point. Second point is that the dollar has basically surged recently. And if you take the revaluation effect of the reserves, you have basically, that probably marked down the Chinese reserve by about $33 billion. So that's the second thing. The third thing is, of course, is expectation from the Chinese resident that the Chinese currency might depreciate. That's why they are trying to pack up and take the money outside the country. That's probably amounts to about $30-some billion last month. So if you take all those three things into consideration, yes, there is definitely capital flight, but it's not as severe as the number that shows. Key point here is, this is a policy that cannot be sustained. They need to do very dramatic reform in the foreign exchange market. They have to float exchange rate. You cannot control both foreign exchange rate and interest rates.
Right.
It is impossible to do both at the same time having capital mobility. So they are trying to achieve these three things at the same time. It is not possible. So the Chinese government has to wake up and realize that you cannot do this sustainably. They have
Impossible Trinity.
Totally. So they have to take some dramatic measure to reform that system.
All right, so that's a work in progress. There is an argument the U.S. can make, though, that China doesn't buy enough of its exports. There's this massive trade imbalance that the U.S. has with China. How does the U.S. government go about fixing that, about encouraging or forcing China to buy more from it?
This is another problem that cannot be resolved very easily. The Chinese have their own grievance, too, because every time, this is like a forever problem. If you look at the recent past, all U.S. government trying to get the Chinese to address its imbalance, trade imbalance problem. But the Chinese saying, well, tell me what you want me to buy. The stuff that I really want to buy are completely restricted. You're not allowed to sell them to me. So if you look at the breakdown of the Chinese import from America, the biggest item is soybean. And the second biggest one is aircraft. So the Chinese government will always argue, I can just buy so much soybeans. I can't feed all my people with soybeans. I mean, there's a certain limit that I can buy. And by the same token, they are arguing, I can just buy so many airplanes. I cannot buy, hundreds of them. So you have to really relax the restriction on me and allowing me to buy the stuff that you're really good at. What are they? Well, the high.
Oh, all right. That was Chen Zhao, Brandywine Global Co-Director of Global Macro Research. We appear to have lost him. Thank you so much, Chen. Coming up, this summer, Eddie Lampert gave $300 million to Sears in an effort to bolster his beleaguered department store chain. Next, we go inside the company's numbers as investors show a lack of faith in its share price. This is Bloomberg. I'm Scarlet Fu. What'd you miss? Sears' survival once again lands at the feet of hedge fund manager Eddie Lampert. He's the architect of Sears' merger with Kmart, the CEO, and the company's single biggest shareholder. With his latest $300 million loan to the chain, he's also helping Sears stay afloat. Sears is the focus of today's The Numbers Don't Lie. So Lampert's loan will help provide funds for the all-important holiday shopping season and reassure lenders and vendors who are nervous about the cumulative $9 billion plus in losses since 2012. Now, that decline is a result of slumping comparable sales. And as you can see here, Sears only posted 1 quarter of positive sales growth since 2000. That was in 2010, that lone green slice. All right, last quarter, same-store sales dropped more than 5%. It wasn't supposed to be this way. Lampert merged Sears and Kmart back in 2005. Investors were hopeful at the time, betting on the company's underlying real estate value, setting the shares above $100 at one point. But sales and the stock, as you can see here, never really picked up. Real estate is key to the company. Sears has raised cash by divesting assets such as stores and its Lands' End clothing business. It's steadily reduced its store count as well since the Kmart merger. Last year, Sears spun off 235 stores into a real estate investment trust in a transaction that raised $2.7 billion. As for this holiday shopping season, there are some early positive signs from the overall industry, with sales climbing more than 2% in the final week of November. There's that blip at the very end of the chart, but they have slowed since then, with department store sales gaining just 0.3% since after that Thanksgiving week. Sears hopes that changes. But in the meantime, the restructuring continues. The company may sell its Craftsman, Kenmore, and Die Hard brands, along with its Sears Home Services repair business, in order to stem those continued losses. We will be following Sears' earnings when they're released before Thursday's U.S. opening bell. Joe?
Time for the Bloomberg Business Flash, a look at some of the biggest business stories in the news right now. Crispin O'Day's flagship hedge fund lost 9% in November. That's according to a note to investors seen by Bloomberg. It means the billionaire money manager is on course to record his worst year since starting the fund more than 2 decades ago. The decline in the O'Day European fund brings the total drop this year to almost 48%. A spokesman didn't reply to an email seeking comment. China Mobile and Alibaba are doubling down on their alliance, beefing up offerings to fend off increasing competition. The parent of Chinese largest wireless carrier and the nation's biggest e-commerce operator will explore opportunities in cloud computing and the Internet of Things. They already collaborate on e-commerce, mobile payments, and IT infrastructure. And Apple is pressing Hollywood studios for faster access to their movies in an effort to bolster its own iTunes business. That's according to people familiar with the matter. Several studios have confirmed they're looking to offer high-priced home video rentals of new movies shortly after they open in theaters. And that's the Bloomberg Business Flash.
Coming up, what you need to know to gear for tomorrow's trading day. This is Bloomberg. missed, the Dow and the S&P and the Dow Transports closing at record highs today. As for tomorrow, don't miss this. China's trade balance for November will come out sometime overnight. We'll be watching those numbers carefully.
And I'll be looking at the ECB rate decision to be announced at 7:45 a.m. Eastern tomorrow.
And of course, Mario Draghi's news conference 45 minutes after that. And don't miss this, right around when Mario Draghi begins speaking, Joe's favorite metric, U.S. weekly jobless claims, 8:30 a.m. Eastern time. That is all for What You Missed. Thanks for watching.
Have a great evening. This is Bloomberg.
Municipal